All right, we are live. Welcome, everyone, to episode 11 of ShipBob's Moving Forward web series. Thank you all for joining. Oh, looks like Ajay is here, so I can invite on stage now, actually. Perfect. Casey, you want to kind of go through a little giveaway as I'm getting Ajay all set here?
Perfect. Yes. Welcome, everybody. I know it's been a tumultuous past couple weeks and couple months, so really appreciate you all taking the time to join us here again. I see a lot of similar faces, and now we have Ajay back in the room. Hey, Ajay, good to see you.
Good to see you guys. Apologies for being a few minutes late.
All good. We're just kicking things off, and then we'll introduce you and jump into the mix. So I love it. We've got so many people that have been joining these lately. They're already telling us where they're dialing in from. So as we always kick it off, here, drop in where you're calling in from. Usually people are coming from all over the world. I'm here in Orange County, so just south of Los Angeles. Nick and Ajay, if you want to chime in as well.
Yeah, I'm down in the Raleigh-Durham area. So it's nice, and they believe it's about 95 degrees and thunderstorms rolling around here. So can't complain, I guess.
Yeah, and I'm here on the East Coast in Boston, and a beautiful 80-degree day. So summer.
Oh, nice! I'm heading up to Boston this weekend. I was born in Cape Cod.
Oh, so, nice, awesome.
Yeah, I thought you were based in on the West Coast, so I wasn't too sure.
Yeah, I sort of split my time 50-50 between.
Okay, nice.
Coasts. But these days with the pandemic. Not a lot of plane flights. So,
Yep. Yeah, so I'll be heading up there, for the rest of the summer, and just, like I said, hanging out on the Cape.
Good for you, man. That's great.
I think it was last week I wore my TB12 shirt because they're a proud ShipBob customer, and also it's how I troll Nick. So I'm glad I didn't wear it today because then.
Well, as a lifelong Pittsburgh Steelers fan, I can't root for the Patriots, but now that Tom Brady is with Tampa Bay, I can root for TB12. So
this session's not going my way, so I might just mute myself for the rest of the time.
People are getting a glimpse into our internal meetings of us just trolling Nick. So here we go. People from Chicago. We got quite a few people from Austin. Good to see that. Some Italy. There we go. New York, LA, Puerto Rico, Babylon, some Kentucky, UK. Love it. So again, welcome everybody. This is episode 11. We decided to postpone last week's episode with everything going on, and we'll get into some of that a little bit later. So we're really excited to have Ajay here with us. So Ajay is a partner over at Bain Capital. He also, a little while ago, was the SVP of Sales and Marketing at Trilogy, which I know this series is called Operators, and I really wanted to call that out because Ajay helped build them up to over $300 million a year annually, and he truly is an operator that got into the VC world. He can talk a little bit about that later. And I'm very fortunate to experience a lot of that firsthand, as he is on our board over at ShipBob. And he's also on the board of, or was at, some of the most influential and innovative companies out there, from Optimizely and SendGrid to those in the e-commerce space like Kiva Systems and Symphony Commerce, and like I mentioned with ShipBob. So it's great to have Ajay here. As a board member, he really goes above and beyond and gets into the weeds with us and helps us spot trends and do things probably 12 months before we might do it ourselves. And so, Ajay, great to have you here.
Great to be here, Casey. Thanks for having me.
And so a company I did not mention that I want to get into first is Build.org. And as we mentioned in the emails, if you all saw, we'll be donating $10 for everybody who comes here to Build.org. And Ajay is not only on the board of directors at Build.org, but he's been serving that position for over a decade. So Ajay, if you could tell us a little bit about Build.org and how you got involved in some of that.
Yeah, like all of you who are joining, I've had the benefit in my career of being part of several startups and entrepreneurial journeys, and it really has changed my life. And there's nothing, and I'm sure all of you can relate. I mean, there's nothing like creating something of your own business, and starting with nothing and no resources, and building it up, from scratch. And about 10 years ago, I got introduced to a social entrepreneur named Suzanne McKechnie-Clark, who had started this organization called Build.org to help students in tough neighborhoods, disadvantaged students, primarily students of color, primarily Black and Hispanic, where the dropout rates in high school were in our extreme, and introduced this idea that starting in ninth grade, you would essentially get, in parallel to your standard academic curriculum in high school, you would get a crash course on business and how to start a business, how to run a business, write a business plan. The ninth grade class culminates in our students presenting their business plan to panels of CEOs and venture capitalists, very much Shark Tank style, and they get a few $100s to fund their business. And these are businesses that you'd imagine high school kids starting, t-shirt companies, websites, things that they sell to other members of their local high school community or the broader community they live in. And then in 10th and 11th grade, they actually run the business. And we have a youth incubator where they work out of. And the requirement for Build is, in order to stay in the program, you got to show up to school. You got to show up to school. You got to stay engaged in school. And so we've been able to dramatically change the dropout rates. But the other part about Build that's really fascinating, I think all of you can relate, is that a lot of these kids, they don't find subjects like math and other things to be engaging, in the standard curriculum. But when they come to Build and they realize they need to know math in order to calculate their profit and loss, that's really powerful. They learn how to open up a bank account. Many of our students, their families have never had a bank account, and the notion of having a bank account. They need to organize as a team. Who's going to be the head of marketing? Who's going to be the head of manufacturing? Who's going to be the CEO? How do you operate as a team? Communication skills. They have to get up on stage at a Harvard Business School and present their business plan to judges. We have events a few times a year where they can sell their wares to members of the community. And I take my family every year at the holidays, and the students come up, shake my hand, and give me the sales pitch. And so they learn incredible communication skills. And so the outcomes we've had at Build have been dramatic. Our students, the vast majority, over 90%, end up graduating high school and going on to a vocational or four-year college. And it really is because they feel a sense of ownership around their businesses, and the same journeys all of you are on with your brands and companies. Our students are on that same journey with Build. So it's a terrific organization. There are a lot of great causes. Our CEO, Ayele Shakur, has been a really loud and vocal voice, particularly in this time period, on how things like digital and online can bring access to the equal kind of education to our inner city youth and disadvantaged youth in the country. So it's a great cause, and if any of you are interested in learning more, don't hesitate to reach out.
That's awesome, and I love how it's the learning by application. I know, for myself, that was always nice. And you do see some of these with, from the Shopifys and BigCommerces of the world with e-com platforms, if we're going to stay in the e-commerce vein, to what we're trying to do with ShipBob, the ability to build and launch a brand at such a young age. And, from the devices like your phone or your computer, which a lot of these kids are using all day, every day anyways, is off the charts. And to be able to have their quote unquote payment be that they need to attend school, just really driving a lot of, that positive behavior. I love hearing that. And so I just wanted to also call out, I really appreciate those of you that replied to Nick's emails about this that said you wanted to further donate with us to build.org as well. So feel free to reach out to us. My email is carmstrong@shipbob.com. I always drop it in the comments as well. So please let me know. And on that note, we'll get into more like the investing and fundraising and the e-commerce side of it. And again, as we've done over the last couple of weeks, for whoever asks the most questions, we'll do some giveaways. So this week, we'll give away a couple boxes of Verb Energy bars. Another proud ShipBob customer. I'm a huge fan. I love those. I love those bars. They're great. So good. Like protein bar meets caffeine. So it's like you can, I don't know. You feel bad drinking one cup of coffee, well, you can have about 5 Verb bars, and then your productivity is off the charts. And then Avron, I see you asked a question. You said you wanted ShipBob to fulfill products, but some of the product was too big. We do oversize and heavyweight, but there becomes a time where maybe it extends even past that. Again, feel free to message me. Here, I'll put my email on here again, because we do have partners that can help help you there as well. So don't hesitate to reach out. So my first question, and we got a bunch of questions from the audience, and I know that we'll get a bunch right now, but to just getting started, Ajay, like especially for these e-commerce brands, are there numbers or metrics or like a singular number or metric that these brands should really focus on in their earlier stages?
Yeah, I think the as you think about the world of creating consumer brands, it's amazing how much has changed, and I think thanks to companies like Magento, BigCommerce, and Shopify, the front end platforms are all off the shelf. You can you don't need to build technology; it's all there. Thanks to companies like ShipBob, fulfillment is there and it's on demand, and you can get going. And thanks to manufacturing now being on demand overseas, you can get your product built really quickly and cheaply and without a lot of upfront money. And so the question then is, okay, how do you compete and how do you build real competitive advantage? And I think that the single most important thing we look for, and this is not the only thing we look for, but the single most important thing we look for is, do you have a product that some segment of customers or consumers really love? The barriers to entry to launch a brand have never been lower. That's good news, but it's also bad news because it means there are thousands and thousands of emerging brands competing for the attention of each and every consumer. And so having something that someone loves and those consumers coming back, that repeat purchase, that repeat frequency, I think is by far the single most important thing to create something that's really sustainable as a brand.
So a question that I actually was planning on asking a bit later, which I'll bring up now because you did mention a brand that people love. And so I'll bring up Outdoor Voices, which I know my wife's a fan of. I have some of their gear as well as they bridge into like men's apparel. They were really like one of the darlings of the direct-to-consumer space. They went through some pretty large fundraising rounds. And then, some things came to light on their revenue, especially their revenue on a ratio to how much they've raised. So as brands, think about fundraising and then look to others that are paraded through the mainstream media, how do you think that they should really approach, what the public narrative is and how to identify if VC is right for them?
Yeah, I mean, I think, the challenge when you get bigger is how do you scale up without having to spend a lot of money on Google? Because as you scale up, the interesting conundrum is that your cost of acquisition actually goes up; it doesn't come down. And so I think that creates challenges for businesses, and so. This is why having that direct relationship to your customer, owning that loyalty, having ways to get to them, through your own channels, whether that's through your website, through your social channels, through SMS. We've got a great company called Attentive Mobile that we've invested in that helps brands with SMS marketing to their consumers, through email communication, but getting them back in a way where you don't have to spend that additional set of dollars on Google. And I think that is definitely the key. And that may require you over time to expand your product portfolio so you have more things to sell that same customer. It depends. Certain product lines lend themselves to repeat purchases, like the energy bars and things like that, or coffee, or a lot of consumable products. Other products like mattresses, don't lend themselves to that, and you may only buy a mattress once every 10 years. So I think finding and really early on figuring out how are you going to control your own destiny to acquire customers, and not get addicted to the Google search engine marketing treadmill, because the costs will go up. Those keywords, there are a finite number of those keywords. And as you keep bidding on more and more of them, your marginal cost is going to increase. And I think this is what, I think a lot of brands, including, Outdoor Voices and others, everything is working. You got the flywheel going, you're spending money on Google, people are coming in, but as you get bigger and you've got more fixed costs to support, and those incremental costs get to be more expensive, that's when the math doesn't work. And so if you don't think about it early on, you'll get to a size and scale where it'll be too late to try and solve that issue.
Perfect. I love it. And I'll repeat some of those. And I know Sean asked in one of the questions here, what are the most effective or efficient marketing campaigns for growth? And so just to reiterate some of Ajay's points. So it's something we think about a lot at ShipBob, and implore a lot of our customers to think about as well. So organic or SEO, and that doesn't work for every product. If you're selling mattresses, there's probably a lot of search volume. It can be highly competitive, but there's at least a search volume there. If you're selling some, unique product that you more or less created from scratch and doesn't really exist, that might be a little bit more difficult. But then it goes to word of mouth, and it's really getting your customers to be your biggest brand advocates. Partnerships are pretty interesting. I know there's a few technologies out there that are starting to explore how can they help people scale and cross-sell across partner websites. Let's say even if you're just running on Shopify, how do you connect to others? So some of the partnership model. The earned social media, and again, I know Facebook continues. I've been on that end where I was running a site called Paleo Hacks for a while, and we had a huge Facebook group, and then Facebook cut organic like by 90% overnight. Fast forward 12 months later, they did it again. But social is pretty interesting. SMS, that's a great point. It's actually been interesting to see a lot of brands remove chat from their website and really push people to SMS, which is very similar to chat, and everybody's on their phone all the time anyways. And then the repeat purchase, upsell, cross-sell. You mentioned the mattress brands as well, but it's interesting to see Casper and others get into things that people might buy more often. Let's say like pillows or sheets or something like that.
And I think that's exactly why, I think the challenge Casper's had as a public company is that frequency issue, which is you buy a mattress. I don't know. I can't remember the last time I bought a mattress. Every 10 years, maybe every time you move. I don't know. It's not that often. And so it's a one and done kind of situation. So you spend all this money, you acquire that customer, you've given Google and all these channels all this money, and then you make a little bit of money on that customer, and then they're done. And so I think that's why you've seen Casper get into sleep technology and pillows and sheets and this whole set of brand extensions, so they can drive additional lifetime value around that particular customer. But it's hard. And again, I think you have to think about it early on. You can't think about it after you go public, which is unfortunately, what the challenges they're suffering.
Completely agree. And then the last one I just want to call out was, just as a lot of companies are thinking of the media and content plays, Glossier is probably one of the best examples, where it started as a blog and has turned into $100 million plus brand. And so as people think, how can they continue to build, what they owned, and then, sell their products through that? So somebody asked who it's Glossier. So
and I think those are good examples. I mean, I think whether it's Goop.com or Kylie Jenner or Glossier, if you own the customer, you own the customer essentially through, either in the case of Glossier content, or in the case of Goop and Kylie Jenner, their celebrity. That gives you a huge advantage. If you've got to get your customer through Facebook and Google, that's a hard to sustain long-term proposition.
Mm-hmm. So some of the brands that are on here today, they might be doing, let's say, $1 million a year, 10 million a year, 50 million a year, and some of them are just getting started. And so as they're thinking of fundraising, how do you view the differences between, let's say, approaching a seed round versus a Series A round or B round? And maybe just give a little bit of background or definition on these for the audience as well.
Yeah, I mean, at some level, these names, seed, Series A, Series B, don't mean a whole lot other than essentially a chronology of your funding. And think of it as, you raise a little bit of money early on to make, to take out a couple risks. You raise more money to take out some more risks, and you raise even further money when a lot of the risks have been removed. the point where you can access unlimited money is when the investors really believe if they give you $1, you're going to turn into $2, that you've got the whole machine and flywheel working. And so, our advice to all startups is you want to try and take the least amount that you sort of figure out the minimum you need to get to that next inflection point, that next point where you can say, okay, first thing, okay, you don't believe I have a product that people are going to love. Let me figure out the smallest amount of money I need to get a product out the door and show that I've got a product that people love. Okay, so you raise that money, you accomplish that, great. Now it's like, all right, what's the next thing you need to overcome? Okay, can I scale that? Can I get more people to go do that? Okay, now I've shown I can go do that, and can I do that cost effectively? Okay, now can I get them coming back? Can I really build, my brand affinity, build loyalty, have people coming back, build out my email list and all of that, show I can drive repeat purchases. Okay, now I've done that. Okay, I need to expand my product line. Can I show that I can expand the product line? We have not only just one product, but we're now building out, a set of products that, allow us not only to drive repeat usage, but the average amount of household spending with our brand is going up. And so you just keep thinking through over time, how do you knock down each of those milestones and kind of raise enough money to get to the next milestone, and not so much money that you're going to scare off investors. And that's why, seed, Series A, Series B sort of represent phases of a company and the phases of the journey, and therefore the amounts go up as you've proven more and more and you've taken more risk off the table.
So Sean has a couple of questions that he posted. One I want to touch on first, which is how does one raise capital for a startup? And maybe another way to frame that as well is if somebody is a first-time founder or just getting started, and likely cold emailing, which is something I've personally started to try to do a lot more, just to keep put myself in uncomfortable situations. Like what is there like a cold email that stands out to you from a first-time founder, or a way that they were able to like highlight themselves or their product and really different from, I'm sure, the hundreds of emails you get every day?
Not really. I think it's very difficult to get, at least institutional investors' attention through a cold email. And so I think that the way to think about it is early days, when you have nothing, you're really going to people who know you and believe in you. And sometimes that's friends and family. Sometimes that's business leaders in the community. Sometimes that's a former boss at your last job. That's typically where you get started. And it might be 10K, it might be 50K, it might be 100K that you cobble together. But usually, for a first-time founder, the only people that are going to fund you, and particularly when you don't have a product yet, the only people who are going to fund you are people who know you and believe in you and have seen what you've done in other parts of your life. And then I think once you have a product, you typically can go to seed investors in your local community, and there'll be certain seed investors, like I invest exclusively in technology and software companies, but there are other investors that invest in brands and direct-to-consumer brands. And so finding seed investors in your city, in your geography, in your country that are focused on funding brands at the seed stage, and finding a way to get a connection to one of them. Now the beauty of running a business that's a D2C brand is any investor can buy your product and check it out, and see if they like it themselves. But I think that's the way you got to go about it. I think, if someone who's running a brand cold emailed me, I wouldn't respond because, one, I don't personally invest in D2C brands. I tend to invest in the technology that supports D2C brands, companies like ShipBob. So I'm certainly interested in it, but I'm not an investor there, and so that's just wasted time and effort because I'm not qualified, to respond, and therefore I won't respond.
And so another question from Sean as well that I know has been getting, I feel like the discussions around it have been really picking up lately is debt versus equity. And so if you just want to share a little bit on your views on where you think it's maybe right for debt versus equity and some of the pros and cons there.
Yeah, I think to the extent you're funding uncertainty, meaning will the product work? Will it sell? Will customers buy it? Can we scale our business? Those are all uncertain things. I think you absolutely have to use equity, and you probably can't get debt. And even if you do get debt, I think it's a mistake. I think debt is to fund known things. I have, $100,000 of inventory that's sitting in a warehouse, and I know that even on the worst, even during a pandemic or the worst possible thing that could happen, I believe I could sell at least half that inventory overnight. Well, that's a known thing. So you can go to a lender and say, look, you should be willing to lend me $50,000 because even worst case, that inventory is worth 50 cents on the dollar. And so that's the way to think about equity and debt. Debt is to fund something that's known, and it really can help you with working capital, and equity is there to fund the unknown.
Perfect. And here's a question from Steven. He leads it with self-serving question. And I want to call out that we welcome self-serving questions. That's why we're here. So ask the questions that you guys want to hear from Ajay or from us. So please. So are you investing, and I think you kind of answered this already, are you investing in companies that fit the criteria you described, 15 to 20 million range, profitable, thriving despite COVID? Our bankers are reaching back out to equity investors.
On the direct to consumer brands, we are that's not an area of focus for us. Again, we tend to focus more on the technology companies that are the underpinnings, and we have a number of companies like ShipBob that would be providing technology to businesses like yours, but we're not really the right firm for a direct to consumer business.
And Stephen, with your question, again, feel free to email me directly. We work pretty closely with a handful of the top D2C VCs out there, some of whom are coming on this or future episodes of this. So again, Nick or I will drop my email in the chat. Happy to check out what your business is doing and intro you to the right people there. So here's a question from Paul. For these direct-to-consumer businesses disrupting traditional brand, let's see, there's a lot going on here. D2C businesses disrupted traditional brand counterparts over the last decade. Can you describe some of the DNA that really stands out to you for these emerging consumer brands or business models that you see disrupting e-com for this upcoming decade?
Yeah, I mean, I think there's a lot of disruption left to happen. I think the pandemic has proven that, for most things, buying online is easier, more convenient, is a better experience. I think we've all gotten used to spending our Sundays breaking down boxes of various things that have shown up, because we can't physically, many parts of this country and certainly around the world, we can't physically go to a retail store. And so I think consumer behavior, a lot of these behaviors are gonna sustain post the recovery, and so I think that creates a lot of opportunity. And so I think the real question, if you're starting a business, is to ask yourself, what am I doing that is going to be hard for someone else to copy? How do I build a unique advantage? And I think the companies that have been successful have brought together a number of elements that have allowed them to win. I mean, Dollar Shave Club, famously, acquired customers through these hilarious videos that went viral, and they were geniuses at it. They had not just one; they had several, and so their cost of customer acquisition is really low, particularly for a product where you had high, again, maybe not in the pandemic when no one's shaving, but pre-pandemic, lots of frequency where people would buy it. And so that's a really creative way to go do it. Other people win because they've got some product that's, really innovative that, is hard to replicate exactly. Others win because they create a voice and a brand and a community and a sense of belonging for a segment of individuals. Some people win because they find a segment of customers that's been underserved, and going after that. And when folks like Amazon are going after kind of the mass market, there's so many underserved segments, that are out there. I mean, I think about what Wayfair did, in the early days of their business. I remember meeting the founder, and he said, "Look, go on Amazon site. How many mailboxes can you buy on Amazon?" And you could buy like 10 different mailboxes. He's like, "Come to our site. How many mailboxes can you buy?" And it was like 500 or 1,000 or 5,000, all kinds of mailboxes. And he said, the difference is we don't take this stuff in inventory. We've designed a drop ship system from all these suppliers where they drop ship it directly to the customer, but we can now offer more inventory than Amazon can, particularly for these long tail products. Now, Amazon has now added that same capability, but it was disruptive at the time and allowed them to succeed. We were small investors in Jet.com, and Jet's innovation was this idea that if you go to the third party marketplace at Amazon, and let's say I want to buy two different things, it'll show me kind of the lowest price, but the Amazon marketplace didn't factor in the shipping cost, and it may turn out that there's a marketplace seller in Boston who's $10 more expensive than the cheapest provider who's in California. But when you factor in the shipping, and the fact they have both items, as opposed to me getting two individual items from two different sellers, so they can put it in one box instead of two boxes, being a split order, then when you factor in the total all-in cost, it's actually cheaper, to get that order from, the supplier here locally. That was a structural innovation that, it was hard for Amazon, just given the way their marketplace was designed to replicate and allow Jet to be able to offer, prices that were cheaper than Amazon's, frankly. And they added, some other innovations like, I don't need it tomorrow, I'm happy to have it in a week, and the price is lower, and all kinds of, I'm willing to take a massive quantity instead of a smaller quantity, and the price is lower. A bunch of things that, Amazon, their model works. They're reluctant to change their website. They're reluctant to change their checkout flow. And a new player can make some tweaks around that. The reason we invested in ShipBob is we really believe fulfillment is a real differentiator. And that experience of someone getting their items on time, knowing where their items are, having that visibility, being able to deal with returns easily, and be able to repurchase easily. Again, if you go back to this idea of building that repeatability, building that brand loyalty, the fulfillment side, I think, is an equally important component here. So I think those are some of the factors and ways that you can create long-term competitive advantage, and it takes creativity, imagination, all the things that I'm sure many folks on this call have in spades.
Well, and I'm glad you called out Wayfair also, where, they went head on with Amazon in an area that was tough for Amazon. It was these oversized and heavyweight products, which we talked about before, which also take up a bunch of warehousing space, and maybe they're doing the drop ship model, so they're not having to eat those costs. And so that's something that Amazon continues to get into more, but it's difficult, and it's almost like a completely different, it's almost like a completely different business on its own. And then, of course, like you said, taking care of that entire fulfillment experience and everything there as well. Our chief logistics officer came from Wayfair, and so he's seen, the pros and cons of that and what makes it difficult, and how they were able to focus solely on those types of products to be the best in class there, where Amazon is, covering the world with everything. But to just focus on, these oversized and heavyweight products is a little bit different. And so, speaking of home improvement products, here's a question from Bob. What about patented home improvement products, a continuous feed paintbrush and roller system? How do you posture this product for investors? And I'm actually going to add a little bit to that. So, we've seen how Lowe's and Home Depot from, when they IPO'd, whenever that was 20, 30, 40 years ago, and their growth, and even since COVID hit, with home improvement products actually doing rather well. This relates to another question that I had for you. So if we were to simplify it, and maybe I'm missing some things here between the team, the product, and like the TAM, how do you kind of break up what's important on like the handful of levers that people should focus on for their business? And then if they're, like he says, if they're going to posture this product for investors.
Yeah. I mean, again, I think, it's hard to generalize because every business is unique, but I think having something that is your edge in the marketplace, that could be product, that could be how you market and distribute, that could be your brand voice, that could be community, that could be some structural innovation around how you manufacture. It could be a structural advantage on, how you go to market. I mean, Warby Parker, this idea that they send you 5 glasses and you get to try on a bunch before you order. Zappos was innovative at the time, saying you could order, unlimited number of shoes and unlimited amount of returns, and you had 365 days to return them. That was creating a real structural advantage, and then they were forced to figure out how to make the economics work, given that structure. So there are a lot of ways you can create competitive advantage, and and to the extent you've got a product that is highly differentiated. The hard part, I think, with products that are highly differentiated, like the home improvement one you described, is how do you simply explain it to the customer? I mean, this is where, even though they're much maligned, I mean, infomercials have always served a real purpose, because it's a way to demonstrate how this product works and why it's differentiated. And certainly now with the explosion of ads on mobile and YouTube, you have more channels, and certainly you have ways to test out an ad like that much cheaper than an infomercial. Although infomercials historically have been very cheap because they're late night in a local geo. And so I think with a product like that, you got to find a creative way to communicate why it works the way it does. I think infomercials are great, like money back guarantee, no risk. You order and we'll throw in a couple other things. And I mean, it feels like by the end of it, you feel like it's a bargain. You can't go wrong to get someone to try something they've never tried before. So
I'm glad you called out the infomercials too, because I think a lot of people think of just certain channels, and that's marketing or sales channels, as being too old school or not working anymore. But there was a time when, billboards got too expensive, and then billboards blew up. I can speak firsthand here in Southern California. Every single billboard is like a cannabis or CBD or like vape ad. And whether they should allow those or not is another question, but it's insane. Like, these companies are obviously making money off of that. And then with the infomercials, we've seen, I actually didn't realize how successful some of these channels could be until I joined ShipBob, where things like Good Morning America or the Today Show, and then on the infomercial side, like QVC, can drive insane amounts of volume. I'm talking tens of thousands of orders within like a 24-hour time period. And so just because it's not necessarily how you buy doesn't mean that it won't necessarily work and work well for your audience. And so it's at least, worth exploring and looking into, and maybe talking to others that you see that may or may not be doing well, because sometimes they will open the books. A question from, actually, here's a question from Nick. So Nick, you're on here. Why don't you ask Ajay?
I'm kind of curious about that. Like, why Walmart would acquire Jet. I mean, what was it back in, was it 2016, 2017 when they acquired him? Correct me if I'm wrong. And then, right recently they announced that they're going to obviously dissolve it. I haven't actually read all the details of it, but I'm kind of curious of like why would they do that? Was it not successful? Did they having more growth on their own e-commerce platform? Kind of just curious what your take is.
Yeah, Walmart bought Jet for $3.3 billion, and the reason they bought Jet was Walmart. The gap between Walmart and Amazon as related to the online sales was widening, and Walmart realized that they had to create change faster, and they had to catch up faster. And so the acquisition of Jet.com was not just the Jet website, but more importantly was the team and the expertise. World-class engineers around e-commerce, an incredible set of processes on how to manage a site, how to deal with inventory, fulfillment. They did it all in-house, but they built in-house kind of a ShipBob-like system, and so I think Walmart got to the point where they created an integrated e-commerce division with two websites, a Jet website and a Walmart.com website. But even the Walmart.com website was really run the way Jet was run. So it was almost like, let's take our existing e-commerce infrastructure and transport it over to Jet.com with two websites. And over time, it just made sense to consolidate it to one website. Once all the learnings and processes and software got incorporated. So I think they view it as transformative. If you look at Walmart's online growth post the Jet acquisition, even well before the COVID situation, has been dramatic. It's been a step change. And I think, their estimates, they spent $3.3 billion. I mean, their estimates said that the market value that has Walmart's increased as a result of their e-commerce sales, is in the order of, $50 billion. So I think it's been a home run for them.
That's great. I love this, where usually, I mean, Ajay is very helpful in general, but usually I'm the one answering all the questions. And so here we get to learn from Ajay for this entire hour. So this is great. So here's a question or actually more of like a statement from David. So they raised capital through, where was the other one? Somebody called out basically the crowdfunding. And so that's another interesting example as well that people can test out, especially early on, where can you build a story and can you build a rabid fan base and build up that audience. And so actually it's from Steven. So once you have an audience, equity, crowdfunding can be an effective option. He said they raised over $1 million so far, doing a small percentage for equity. We've seen people use crowdfunding rather well. We had Backblade on here a couple weeks ago. They launched with a Kickstarter project, which then they morphed into an Indiegogo project, and now they're going to do, into the 8 figures this year, when 5 years ago, all it was an idea on Kickstarter and Indiegogo. So definitely another option as well. So here's a question from Sean. And again, I know there's not like a one-size-fits-all to these questions, but how quickly do VCs want a return? What percentage, and how do you evaluate the return that you're looking for in an investment?
Yeah, I mean, there's no fixed answer. The more risk there is, the higher the return. The less risk, the lower the return. And so, think of it as a spectrum, and think of risk as what are the odds you lose all your money. And for a brand new startup, the odds you lose all your money are really high, 70%, 80%, 90%. And so you want them, if 7 out of 10 aren't going to work and are going to be zeros, those other, 3 out of 10 need to be, at least 10x return in order to get a decent return overall. As company gets public, the average return of, the stock market, over the last decade is, somewhere in the 10-12%. So you're getting about a 10 to 12% return a year because the risk is a lot lower. So, we as a venture firm, we aspire to have returns, in the 30 to 40% a year. Public stock market's 10% a year. And then later stage growth equity, maybe more like in the 20%. So, and then, treasury bills are earning 0%. So, it's just, think of it as one axis is risk and the other axis is return. And I'm phrasing return in terms of an annualized rate of return. So if you put $1 in, each year, how much will I have at the end of that year compounded over some period of time? And think of that as, for early stage venture, 30, 40, 50% IRRs is what you want. And for T-bills, and high risk, and T-bills being zero risk, but zero return. And so you just have a nice graph that maps risk and return.
And so similar, another question we got from the audience was, and you kind of answered this, but from these important factors that you look at, and it depends on the stage that you're coming in as well, but is it, a return on investment, like just based off paper valuation? Is it actually like cash in hand? Like, how do you guys evaluate and balance that? Because obviously there's a point where you want to put money in your pocket and also in your LPs, or where you guys are getting your money as well.
Yeah, I mean, startups are hard. It's a long journey. We're patient capital. I mean, that's the benefit of investing with an institutional firm versus individuals, is we have a long time horizon. And so most of our companies that we fund, it's typically 7, 8, 9 years before we see a return. So it's a long horizon, investment vehicle. Stock market, I can buy and sell a stock. I can buy stock today, sell it like a nanosecond later. In our business, we invest in a company today, and we likely are not going to see the end of the journey for 7, 8, 9 years. That's how it works. We've been investors in ShipBob, I think now for, this has been 3 years. We think ShipBob will be a multi-billion-dollar revenue company. And so we got a long road ahead of us.
Love that. Completely agree. So here's a question from some guy you may have heard of before, Dhruv Saxena, our CEO. So he chimed in. He says, "Thank you for doing."
You didn't tell me Dhruv was going to be on here. Man.
Hey, Nick, boot him out.
Too much pressure.
Get back to work. So he says, "Thanks for doing this. Of course, after having done venture for several years, you've probably seen all types of companies. Any stories you can share of companies which were debated internally as risky or hard investments that proved out to be otherwise?"
A really fun investment we made was Kiva Systems, which was a robotics company that it was a really innovative company that used robots to automate e-commerce warehouses. And the fundamental insight the founder, Mick, had was that, in these big Amazon warehouses, the average fulfillment worker was spending 80 to 90% of their time walking. I decide I want, sparkling water and a book, and the sparkling water is on one side of the warehouse and the book is on, the other side of a 1 million square foot warehouse. And so that worker, in order to fulfill my orders, now spending all their time walking. And so Mick's insight was, what if instead of having the worker go to the inventory, what if you had the inventory come to the worker? And so he created this idea of inventory sitting on these mobile shelves, and then using autonomous robots that would determine, okay, I want the sparkling water, and I want this, I don't have a book handy, but I want this book. One robot would go off to fetch the shelf where the water was sitting on, and another robot would go off to fetch the shelf with the book on, and they'd bring both shelves directly to the worker. And so now I, as a pick worker, I'm not walking, I'm standing there. Both shelves show up in front of my face. I pick the sparkling water. That robot takes that shelf away. The next shelf comes in, and then I get the book. And so at the time of the investment, the company had no customers. It had a prototype that was operating in a small, little room in Burlington, Massachusetts. And so I took my partners there to see it in action. It was cool. The shelf would show up, and they had a little demo where there's a tablet, and you could put an order in for chips and this and that, and the shelf would come, and you'd pick it and scan it, and it was really cool. But we were like, man, going from this to a 1 million square foot warehouse, will it work? Will these robots run amok? Shelves falling down. It seemed like there were a million things that could go wrong in making this work. We didn't know how, at the time, it was unclear how big e-commerce was going to be, how fast it was going to get adopted. We didn't know how big the market was going to be. And we debated that heavily, and added complication for me as the partner who's leading that investment was the day of the investment committee. My wife informed me that morning that she was giving birth to our second daughter, and so I had to participate by phone
from the hospital.
Yeah, from the hospital. And I thought, okay, this is not ideal. But we ended up getting there. We got the partnership convinced, and it was one of these things where it took a while. The first couple of years, we were calling all these customers, and everyone was like, "This is cool. This is great." When you've got your first 10 customers aboard, where I can go visit a warehouse where it's all working, sign me up. But I don't want to be the first one. And through one of my colleagues at Bain Capital, we had a relationship with Staples, and we were able to get to someone very senior, the gentleman who ran all of e-commerce distribution, and just we begged and pleaded, and we're like, just come see it, come to Burlington, see this thing in action. He came and saw it, and he called me up and he said, "We're going to be a customer." And it turned out Staples was our first customer. And when we finally got that first warehouse in Colorado up and running, I mean, it was, I can't even describe what it was like visiting that. And that's when the dominoes fell. Walgreens and Gap and Zara and all the other customers sort of down the line. And ultimately, Amazon now owns that technology. But that was a really fun one because, a lot of what we invest in our software companies, you can't see it, you can't touch it. In Kiva's case, we could see it. That's also one of the things we love about, ShipBob. I still remember, when we started spending time with Dhruv and Devay, and being able to come out to the fulfillment center in Chicago and see what ShipBob had built, not just the warehouse itself, but more importantly, all the software, the processes, everything was running so smoothly. And I had the benefit as a venture capitalist of having been in warehouses before and having seen what a world-class fulfillment center looks like. And here's this young startup at the time. You guys obviously are much bigger now, and a very sizable company, but at the time, small startup. And the software that you had built and the processes where the warehouse was running, blew me away, which is why we leaned into that investment.
Love it. So we're almost to the top of the hour somehow. So as always, really appreciate everybody joining here. I just have a couple more questions for Ajay, but I know there's a lot going on right now in the world. Plus you have your own businesses and family and everything. So as always, really appreciate you all taking the time. We'll be here every Wednesday, 3:00 Eastern time. And probably the best news from Nick, he just mentioned that he's got to rerun the numbers, but it looks like we're at 1K for build.org. So
awesome. That's great. Thank you so much, everyone.
Yeah, thanks everyone. Honestly, this is probably our highest attendance rate that we've had for one of these sessions. So, everyone, thank you really so much. I know there's some other people that want to just donate themselves too. So really cool to see.
It's great. Really I know it's a tough time in our country, and it's great to see everyone come together.
Yeah. And so last question we always ask everybody, what's your number one piece of advice right now for entrepreneurs and those in the attendance?
I think my main advice is, it's no longer possible to take a narrow view of capitalism. I think the winning companies in the future are going to take a more holistic view of capitalism, and that holistic view means creating value not just for your shareholders, but for all the stakeholders. Those are your employees, your community, the city you live in, the broader set of ecosystem that you're benefiting from. And I think the reason why that's important is when you think about this next generation, the sort of the next set of folks entering the workforce, people in their 20s and early 30s, this is becoming for that generation a really important criteria for where they want to work and the kind of culture they want to be a part of. And this is not a political statement, regardless of what side of the aisle you sit on, whether you're liberal or conservative, Democrat or Republican. It doesn't matter. I think you can embrace this notion of thinking about all the stakeholders and building a company and a culture that thinks about all the stakeholders, and even the most diehard capitalist will recognize that it's in their self-interest in order to create the culture and recruit the talent that they want to recruit. So I think especially as we've seen the forces, and all the turmoil in our country right now in the U.S., and I know a lot of support from folks around the world for everything going on here. It's more important than ever for leaders like all of you to have a more holistic view, and we as investors look for that as well. So that would be my one piece of advice.
Love it. Well, I'm not going to top that. So great way to sign off, especially it's very timely for right now. So Ajay, as always, great to hear from and learn from you, and really appreciate you taking the time. And again, everybody who joined today. So thank you very much.
Thanks, guys. Grateful to be here. Nice to meet all of you. And, we certainly put our money where our mouth is. ShipBob's a fantastic company, and our excitement on the business over the last 3 years has only grown. So hopefully many of you are customers, and if you're not, definitely check it out.
Perfect. Thanks. Bye, everybody.
Thanks so much, everyone. Bye-bye.